As a high-income earner, there's a good chance you're worried about tax time. Knowing that you're in a high tax bracket can be a bit stressful, especially if you aren't aware of tax reduction strategies. Fortunately, there are dozens of things high-income earners like yourself can do to lower taxes. You simply need to know what your options are and how to take steps to use them. Hi, I'm Mark Fonville with Covenant Wealth Advisors. I know it can be hard to stay on top of those consistently changing tax laws, especially those that affect high-income earners. In this video, I'll help you understand the available options for reducing taxes when you're in a high tax bracket. Let's get started. You may already know about the Tax Cuts and Jobs Act of 2017, where new tax legislation made small reductions to income tax rates for many tax brackets. You may not know that those changes were temporary and ended up increasing the standard deduction for both individuals and joint filers. Now, higher standard deductions make finding itemized deductions for high-income earners quite difficult. Another tax law that made things tricky for those in a high tax bracket was the Secure Act and Taxpayer Certainty and Disaster Tax Relief Act of 2019. With both of these laws and the changes accompanying them, using tax relief strategies as a high-income earner is harder. Still, it's not impossible as long as you're prepared. First, let me ask you, do you understand your tax bracket? You know that you're in a high bracket, but are you really sure what that means? The ordinary income tax bracket is the percentage of tax owed to the IRS on every taxable income tier. As a high income earner, you need to understand how every one of your earned dollars will be taxed. Depending on your high income, your tax rate is somewhere between 32 to 37%. With the Secure Act came provisions that affect your retirement and tax planning. Some of the provisions you'll want to know about include a higher age for required minimum distributions, no age limit for traditional IRA contributions, an increase in annual limits for simple IRAs, a raise in Roth IRA income ceiling, a base wage increase for Social Security, and an increase on limits for long-term care premium deductions. These provisions are important because they provide you with greater opportunities for deductions. The more deductions you find, the lower your tax bill will be. Your tax deductions will be broken into two categories, above the line and below the line. The line itself simply refers to your adjusted gross income. Above the line deductions actually reduce your AGI, which can help you qualify for additional deductions or credits. You may be able to claim above the line deductions such as health savings account contributions, deductible traditional IRA contributions, qualified retirement plan contributions, and qualified charitable donations. Below the line deductions are standard or itemized deductions that are determined after your AGI is calculated. Most taxpayers take standardized deductions, as itemized ones are much more difficult than they once were, especially for high-income earners. However, with proper planning and understanding, you can effectively itemize your deductions, which gives you the ability to greatly reduce your tax bill. Focus on itemizing your deductions in order to claim charitable contributions, mortgage interest expenses, and medical expenses. Another tax reduction possibility is income deferral or acceleration, which has the ability to reduce your income, capital gains, and the Medicare 3.8% surtax. While deferral could help you compound savings and investments, current tax rates expire in 2025, which could cause a higher tax rate on deferred income. When thinking of deferring your income, consider any non-qualified deferred compensation contributions, ask your employer to defer income until 2023, and look into deferring or accelerating any IRA withdrawals upon retirement. Income tax deferral may be an effective tax strategy for current tax year liability reduction. It can also compound returns quickly, sheltering income from current taxation. Tax-deferred investment vehicles you may want to consider are qualified retirement plans, 529 plans for education, and cash value life insurance. Other things to consider when developing your high-income tax strategy are converting IRAs into a Roth IRA, purchasing tax-exempt bonds, restructuring your business entity, investing HSA contributions, investing in tax-efficient index mutual funds, managing large gains, and bundling 529 plan contributions. Filing taxes as a high-income earner can be overwhelming and worrisome. Fortunately, there are a number of strategies that can help you reduce your tax bill. Tax planning really should be done as part of a comprehensive plan that addresses your total financial life. If you're interested in learning how our team can help you reduce taxes, invest tax efficiently, and plan for retirement, call us at 888-320-7400. Our team at Covenant Wealth Advisors is here to help. Thanks so much.